What's up, everyone? Ben with the BTC Sessions here, and this is your daily session.
Hodl that Bitcoin.
Before we jump in, just a couple quick things. Of course, shout out to sponsors of the show, Ledn.io. This is where you can use your Bitcoin for a couple of different services, one of which is to use it as collateral to obtain a Canadian or US dollar loan, and the second of which is a Bitcoin savings account where you can earn interest on your Bitcoin paid in Bitcoin. For either of those services, you can click the link down below, and if you actually opt to get a loan, they will credit your account with an additional $50 worth of Bitcoin. And secondly, if you're into Bitcoin, then of course, privacy is important, and something that I use on both my phone and my computer is NordVPN. This helps hide your IP address, it encrypts your browsing data, and it has the added benefit of being able to unlock geo-blocked content. So if you want to check out the link down below, there's a special deal where you can get it for $3 a month. And with that, let's dive into the news. All right, so this is actually came out a few days back, about a week back actually, and I've seen it tossed around a little bit, but I wanted to touch on this article, and it's talking about Bitcoin market dominance, which in itself isn't a great metric when used very basically. And so market dominance or market cap dominance is referring to the number of outstanding coins times the price of each coin. You get a number, and then you compare those numbers and put the coins in number from highest to lowest. And that's more or less how market dominance is figured out on a website like CoinMarketCap. Now, the problem with this is liquidity, as in what happens when you go to buy or sell a large number of coins. If there's lots of buyers and sellers in the market, then that shouldn't move the price too much. But if there's a total lack of liquidity, then that can impact the price a lot, and you may not be able to sell the coins you have or buy a certain amount of coins without moving the price a lot. So an instance of this is, let's say I wanted to create Sessions coin today, and I said there's going to be 1 billion Sessions coins, and I managed to sell 10 of them for $1 a piece. So I make a sale for 10 Sessions coins and I make $10. Well, by that logic, if there's 1 billion of them, then $1 times 1 billion coins, my coin now somehow has a market cap of $1 billion. But that's not really fair to say that I would be placed that high on the rankings list. So what this article covers is adding in liquidity as an aspect of this measurement for market dominance. And so when you do that, currently Bitcoin is getting close to the 70% market dominance number without factoring in liquidity. But when you factor it in, it actually is 90% or above, depending on how you're getting your measurements. So this is how they've broken it down. So over here on the right, we can see the coin market cap measurement. And what they've done is they've done two measurements, one with just all cryptocurrencies and others with the stable coins excluded. So anything that's just pegged to the US dollar, like Tether or USDC or whatever else you're looking at, something along those lines, those wouldn't count because essentially they're just dollars. It's not its own free floating currency. So they've done two measurements, whether or not you want to include those numbers. So if you look at CoinMarketCap, with or without the stable coins, it's essentially around 68 or 69% at the time of this article, which is pretty much the same as currently in the market as well. Now, they've now done also volume weighted by CoinMarketCap. Okay, so how much volume is each coin getting on all exchanges everywhere? And if you factor that in, then on this measurement, 90% of everything would be 90% of everything would be just Bitcoin, which is insane. And Furthermore, if you go even further to the left, there was a report put out by Bitwise recently where a lot of exchange volume is totally fake and it's wash trades and it's just BS that exchanges do to get listed high on CoinMarketCap. But if you look at real exchange volume, there's about 10 or so exchanges that really sit up top that have real volume, that are real trades, that are regulated enough that you can't do things like wash trades. And so if you just look at those exchanges and you just look at actual cryptocurrencies, not just stable coins, or you exclude the stable coins, then Bitcoin is literally 92.4% of all cryptocurrency activity on exchanges, which is absolutely, I mean, it makes sense, but in comparison to that 69% that we have listed on CoinMarketCap, it's a far cry. Like that's over 20% difference, and essentially the whole market, which is pretty staggering. So I encourage you to check out this. It does go into further detail of how they got these numbers, but I will include that link down below. So moving on, there's another great article put out today, and I'll scroll to the top of this. It's pretty deep. It's an in-depth read. This was done by James O'Byrne. I'm not quite sure how to say it. He's from Chain Code Labs, but anyways, really solid. I recommend you follow this guy. He's this article. If this article doesn't convince you to follow him, I don't know what will. But he's talking about Bitcoin for safety in the face of the financial issues afflicting the markets today. And so I'm going to try and parse through a little bit of this, but really you have to read it because I'm not going to do it justice and I may fudge my wording a little bit. But anyways, so he says that essentially what we're looking at in the markets right now is one of two things are going to happen eventually. One, a massive crash, the likes of which we have really not ever seen, or unprecedented actions on the part of governments and central banks to avoid said massive crash. So what's the reason for this? Well, one is that we have, for the first time ever, negative interest rates. And so what does this mean? Particularly in Germany right now, if you go and buy government bonds, 30-year government bonds, which means your money will be locked up for 30 years. And typically this is something that somebody that wants their money to sit safely without any real, well, I shouldn't see any real risk, but with minimal risk to their capital to get a nice small amount of return, but mostly preserve their purchasing power, you would typically buy bonds. So this is, retirement funds, people that have kind of invested over their lifetime and are moving into safer assets with less volatility, moving out of equities. That's what this would be for. Well, you now have negative interest rates with bonds. So that means instead of getting a return, a slow, steady return on your money over time, well, now you're actually going to be losing money. Now, it's not a lot of money technically that you're losing. So if you put $10,000 in one of these bonds for 30 years, you would actually lose $11. That's the rate that they're giving you bonds at right now. And with that, you're not even factoring in, that's just monetarily. It would make more sense monetarily to stuff that money in a mattress than to buy bonds. Not only that, but you're also need to factor in the risk of default, which the German government, not super likely, but you also need to factor in the risk or absolute certainty, I would say, of inflation, of extreme inflation. What are the odds that your $10,000 30 years from now are going to be down in purchasing power, especially if your return is negative? You're compounding that with inflation. So you're losing money plus you're losing purchasing power. Whereas with a bond, typically you would hope to at least keep up with inflation, if not a little bit more. So what is this doing? This is forcing retirement funds and people that typically would be sitting in very conservative investments, and it's forcing them out back into riskier equities, which can fluctuate quite a bit and can impact your retirement fund if you hit the wrong point in the market where you need to start pulling money out for your retirement. Now, it goes on to show the nice thing here is he interjects momentarily with these outlined sections which say this is what Bitcoin is for, and goes on to describe how Bitcoin can be a hedge against something like this because it's could potentially be an uncorrelated asset. So he talks about how did we get here? Well, starting in '08, there's just been unprecedented money printing, and this was due in large part to governments and central banks trying to smooth out the market cycles. They're trying to smooth out the booms and the busts that you would typically see so that you just see this nice steady gradual incline of the value of stocks. Now the problem with this is how they've achieved it, and they've printed just a ridiculous amount of money, to the tune of well over $3 trillion since 2008. So the monetary base has just, I think it's quintupled. And they basically threw out any any reason when it came to printing money. They said that no amount is too much. We'll just print and print and print and hopefully correct this. And I mean, we have been on a tear in the stock markets since the recession. It's been a long time. It's been 11 years now. And so what this has actually caused is cheap credit, right? So if you're looking at negative interest rates, as insane as it sounds, in those places where you can get negative interest rates, you get paid to borrow money. There are places in Europe where you can borrow money to buy a house and they'll pay you to keep that loan. So what has this done? Well, now you have companies that can basically borrow money for cheap or nothing or get paid to borrow. And what are they doing with that money? Well, they're pumping up the stock market. You can see it has gone up two and a half times beyond what it has ever been. And so the stock market is heavily inflated. They're buying up real estate. So the housing market is way more overbought than it was in 2007. And not only that, but they're doing so in relation to the stock market. Companies are actually using this cheap credit to do stock buybacks. So they're buying back shares of their own stocks from retail, and that in turn means there's less on the market and it inflates the value of their stock, meaning that executive held shares in the companies are then skyrocketing in value as well because there's less on the market. They're able to buy it back with the credit that they've created. And it balloons the stock market out of control. However, at this point, what we're looking at is the main source of equity demand, of stock demand on the market, is from corporations buying back their own stocks. And they're only able to do that because of cheap credit, because of money printing. And so we're in a situation where in order for stock markets to continue with their trajectory, essentially you cannot have highly priced credit. You cannot have higher interest rates because then corporations will no longer be buying back their stocks, and you won't have this kind of propping up of the stock market. And when that drops, well, you've already got negative interest rates on your bonds. So all of a sudden, and not only that, but the negative interest rates on the bonds have forced people into equities. So those that are relying on the stock market constantly going up would have their retirement fund crushed if it suddenly were to go down. And so we're at this point where what the hell do you do? And it kind of seems like the answer is just print a shit ton of money and hope it works out. And that's essentially modern monetary theory, this new school of thought where it's just, we'll just print and that's the solution. And so there's so much here. It's a good lengthy read, but I encourage you to check it out. It's eye-opening though. Go through this. It is very informative. So I'm going to move on from there. Hopefully I haven't given you a heart attack. Well, actually, if you're holding Bitcoin, then maybe I've brightened your day. But moving on to an interesting bit of Bitcoin, I guess not news, but info about how Bitcoin works. And so This is BitMEX Research on Twitter, and they essentially monitor the Bitcoin blockchain and what happens and if there's forks and so on and so forth. And a lot of people don't realize this, but Bitcoin used to quite regularly have competing blocks. And what I mean is miners are trying to mine blocks of Bitcoin. They're trying to put together a ton of transactions and essentially solve a mathematical equation the quickest that they possibly can. And if they solve it, then they get to say, okay, I've put together these transactions. This is the next Bitcoin block of confirmed transactions. And then everybody builds on top of that one after they check their work. However, from time to time, you may get two people in different parts of the world that solve that transaction so close together that their proposed solutions to the block end up kind of propagating through the network at the same time. And there's a period of time where people are unsure which direction the chain is going to go. So essentially you have this split where it's, okay, this person solved the equation and this person solved the equation. They both have their own set of transactions that they put together for this next Bitcoin block. And you're essentially waiting to see which miner will solve the next block and which block they end up building on top of. Okay, so you essentially have this split where it's like, well, it's going to be one of these two, and you're not quite sure which is which. And that is what has happened today. Now, again, this used to be commonplace, but because of the innovations and continued I guess they've essentially just made it much more efficient to run Bitcoin so that the block propagation, the information is spread much more quickly around the network. So this is a relatively uncommon thing now compared to what it used to be. It used to be essentially daily. You would see this. So anyways, it just kind of catalogs what happened, how it split and said, okay, well, this is now the winning chain and this is the Bitcoin network. And what you get is an orphaned block where a miner has mined a block quite legitimately. They've put in the work. It's just that they crossed the finish line at the same time, and it just so happened that the next miner to go went with this chain versus this chain, and therefore that miner does not get the reward, and we go on this pathway. It looks like typically you don't have transactions that are purposely excluded in this way. It just means that the transaction's sitting there waiting to be confirmed. If they weren't confirmed on one of those blocks, then they'll probably be included in the following block after that, and so on and so forth. So anyways, a little bit of interesting info there. Feel free to check that link down below. They also have their website, forkmonitor.info, and you can check out more about that. And up next, this came up to me. I had somebody asking me, actually here in Calgary, a friend of mine, asking about Bitcoin confirmations and when is it safe to spend Bitcoin that you've received? Is it safe to spend it before it's confirmed, and so on and so forth? And essentially, the rule of thumb is if it's a larger transaction, you want to be very certain, then 6 Bitcoin confirmations, which are about 10 minutes a piece, you can be pretty damn certain you're safe. It would take a lot of work to backtrack and change your transaction, and we've never seen something like that happen before, which is about an hour. And so this website actually goes through and catalogs how many or how long it would take or how many blocks or whatever, depending on what metric you're looking at, it would take of different cryptocurrencies to achieve the same amount of certainty and security that a Bitcoin transaction with six confirmations on the Bitcoin blockchain would have. And so you can click on the different metrics here to organize in a certain way. So I've clicked on difference as far as how many times slower are the other chains. So you can see here, 6 confirmations on Bitcoin is about an hour. Well, on the Ethereum chain, to have the same amount of security and certainty that your transaction is going to be basically set in stone, it would take 6 hours and 20 minutes. So it's about 6 times slower. As you move down the list, Litecoin is 33 times slower. Bitcoin Cash, pretty much the same, 34 times slower, Zcash 42, and you move down and down, Bitcoin SV is 81 times slower, Ethereum Classic 91 times slower, and remember, Ethereum Classic actually got 51% attacked to shit. Somebody attacked an online exchange, I think a couple online exchanges. They were able to deposit Ethereum Classic, they were able to buy a bunch of power on, I think, Hashflare or something like that. Anyways, they were able to buy a bunch of hash power on Ethereum Classic and then 51% attack the network to make it seem as if they had never deposited the Ethereum Classic. Meanwhile, they turned around and traded it for something else and withdrew it and cost millions of dollars to that exchange. So it just goes to show how insecure some of these chains can be and how important it is to have that rock solid security of the Bitcoin blockchain. Now, in reference to can you spend it if it's unconfirmed? Technically, yes. So you can receive money into a wallet. You can change the settings so that unconfirmed Bitcoin is spendable, and it will broadcast to the network. And if it's not, if there's not a lot of traffic on the Bitcoin network, then everything should confirm all right. But it's not best practice to. And I always say if it's a small transaction, even still, best to wait for at least one confirmation before going ahead and spending. But it is technically possible if it's a larger transaction. You know, if you're buying a car or a house or something like that and you're using Bitcoin, you know, wait the hour, you're probably good. So anyways, you can check out this website, howmanyconfs.com, howmanyconfs.com, and you can go through the list there. And finally, I was talking last week, I think on Friday, about SatsApp. I've been using it on my phone. I quite enjoy it. I think it's pretty cool. And this is linked with my Casa node, which I guess you can't see. It's a little lower. I changed out the shelf behind me. But this is a fun app. It's a good way to be able to connect to your Casa node, use Lightning in a trustless fashion so that you have a full Bitcoin node and a full Lightning node connected at home through Tor. So I've been playing around with it. I've been using the heartbeat feature, which essentially calls back to your node whenever you want to, and it'll check that you have that it's functioning properly. And if you get on a hot streak and you do 5 out of 6 days in a week, then on the 7th day you will be awarded, I believe it's 10,000 sats for doing that, and it takes a couple seconds each day to do it. So really cool. I really like it. And yeah, if you want to play around, I am, if you can see it, at BTC Sessions on the SatsApp. That's my Sats tag. So hit me up on Twitter and let me know if you want to test going back and forth. Also, this is in beta right now. So if you do have a Casa node, you have to apply for beta access and they will eventually email you a link to download it. But I'm sure that in the coming weeks or however long they will release this to the public. You do have to have a Casa node to access it, but I'll link to my tutorial on how to use the Casa node as well if you're interested in that. And I think that's it. I'm going to wrap up here. Thank you guys so much for watching. If you're new here, of course, hit like, subscribe, and share. Always share. It's always great to get more eyeballs on these videos. If you want to help the show in another way, either of the sponsors I mentioned at the beginning, you can hit those links down below. That is Ledn and Nord, both down below. And finally, if you really liked what you saw, you can always hit me up with a Lightning Network tip at my tippin.me page, or I guess SatsApp. If you want to send something there, then that's cool too. And with that, I am out. I will see you guys tomorrow for your daily session.